G'day everyone, welcome to this global update for stocks and commodities for the 8th of March. Things were going along pretty well last week until a very good jobs report came out in America on Friday night, and that saw a significant fall in most asset classes, stocks, currencies, commodities. The selling was very broad-based. So this is a really important addition because it raises a number of questions about what's going on in the global markets. So I'll be going through things in quite a bit of detail in this particular issue. So let's look first of all at the American market. The S&P was down quite heavily. We'll have a look at the chart on that, and obviously most of that was on Friday night. So it raises a question, why such a big sell-off, and has anything really changed in America? It's quite strange these days that good news equals bad results on the stock market. Now the easy answer is, of course, that people are fearful that that's going to mean that the Fed's going to start raising interest rates earlier than normal, and that's going to be bad for stocks. For a start, history shows that that is actually not correct. Stocks tend to go up for another year to 2 years after interest rate rises start. And there's a whole lot of other question marks about what actions the Fed may take. So that's by no means a given. So there were declines across most sectors and other asset classes as well. The interest rate sensitive sectors, utilities, in particular, were hit particularly hard. They were down about 3.5%. But when you really look at the trends in those sectors, they've been trending up very strongly, much more strongly than their normal stable business would indicate. And so I think it was just a case of they just got ahead of themselves, and some selling has brought them back to their long-term uptrend. And if you look across the American market at the S&P index as a whole, and if you look into the individual sectors, the uptrends are not interrupted at all. Now, it was a big fall on Friday night, and it was very sharp, but we know these days that a lot of things are driven by computer algorithms, and sometimes they can just feed on themselves over a very short time period of a few hours and end up producing some significant volatility. The other thing that's really interesting is that the VIX index, the volatility index, only spiked up from 12 to 15. Now, I would have expected, given the size of the falls in the stocks and in treasuries and in some commodities, that the volatility index would have spiked up closer to 20. So I think that's really interesting, and one of the basic reasons why I think this is just going to be a short-term aberration. That's my overall view. Now, I just want to have a look at the rate rise question. Rate rises sometime in the second half of 2015 were already priced into the market. There's no question about that. The market has been expecting this for some time, so there was already an element of rate rises priced in. Now, there's a group in America, the CME group, who looks at these things very closely, and they've assigned, based on the yield curves, they'd assigned a probability of a rate hike in June at 16% prior to Friday night in the jobs report, and they assessed the probability after that rising to 22%. So that's all well and good. But the thing is that the probability was assessed at 24% only 5 weeks ago, when we were in the middle of quite a substantial rally. So the probability is still lower than it was 5 weeks ago, yet stocks sell off. So that's a bit of a mystery, and lends weight to the fact that I think the sell-off on Friday, even though it was pretty big in magnitude, and we may get a bit more follow-through yet, I believe it will be quite short-term. The other question, of course, is how quickly will the Fed raise rates? They may only raise rates by 1/4 of a point and then do very little for the next 12 months. Who knows? There's a lot of unknowns around this whole thing. And will that impact stocks anyway? I can tell you without any shadow of a doubt that history shows that once the interest rate cycle starts to turn to the upside, that stocks continue to outperform for at least a year and sometimes up to 3 years. Now, the reason for that is perfectly logical, and that's the fact that when interest rates start to rise, the economy is doing better. And when the economy is doing better, then corporate profits are rising and stock prices do well. So, it's just, if rates start rising in June or whenever it is this year, it's actually not a given that stocks are going to fall. Yes, we've had this sudden little blip down, but as I said, that could just be some very short-term computer-generated trading. So the answer to what's actually happening is, as always, a combination of different factors. It is a fact that earnings growth is slowing in some sectors, but certainly not in others, and certainly not in the sectors where my focus has been in the American market. The companies that I'm investing in, the earnings growth is coming through, continuing to beat expectations and beating expectations by a big margin. So you've got to be careful to separate what is happening in the general market and what is happening with the stocks that you're actually trading. Now, some sector valuations were basically priced for zero interest rates, and some of those were the interest rate sensitive ones of utilities and real estate trusts. So naturally, there's going to be a bit of an impact there, and some of those sectors have just run too far. So now we've got a situation of huge uncertainty about how fast rates are going to rise and what action the Fed will take. Even if stock prices do start trending down, it's quite likely if stock prices start trending down, the Fed will take some action to stop that, because quite clearly they're on record as saying in so many words that part of our intention, we've got intentions around inflation and we've got intentions around the job market, but we also have an intention around boosting asset prices to create a wealth effect so that people will spend. The Fed has said that very, very clearly. So if they start raising rates and stock prices start going down, then they're going to do something about that. You can bet your life on it. And that's one of the reasons that I have been so confident about where the American market has been going since late 2013. I've consistently said every week, every month, that 2014 was going to be a good year and 2015 could be an even better year. And I see absolutely no reason to change that. So let's take a look at some of the markets. Should get to the right screen. So we'll start first of all with the S&P 500 index, and you can see we've got a fantastic uptrend still in play. Yes, we had a sharp dip in October, but since then the market has gone up again. It's consolidated. It's broken out to new all-time highs. We've gone above the technical resistance of 2,100 points. Yes, we've pulled back sharply on Friday night, but this Fibonacci retracement scale, we've got potential support kicking in at 2063 and also 2046. I'll be surprised if it goes much below those levels, and I'm looking at the moment at probably 2046 as being a key support level. But look, we'll just play the ball as it comes down the pitch and not have any preconceived ideas that we're particularly wedded to. Now, just looking at the VIX index, I mentioned the VIX. Now, this chart hasn't updated, but I can tell you that this app hasn't updated for a couple of days for some reason. The VIX had got down to around 12 or 13, and then on Friday night it spiked up to about here, about 15.5. So you can see it's hardly moved off the bottom, and that's another reason. People just aren't panicking. The VIX index reflects how much people are buying put options in the market to ensure their portfolios against further falls. And there's just not that much fear in the market at the moment. So that's why I'm not particularly concerned about what's going on. Now, turning to Aussie stocks, our index was down by 29 points for the week. We obviously will lose further ground on Monday. And the short-term gyrations that we're seeing in the market basically can't be predicted based on fundamentals or based on common sense. If they were, the Australian market would be nowhere near 6,000 points because the valuations of the banks and a lot of the other high yielding stocks just do not remotely justify our index being at 6,000 points based on fair value. But it is, and it's there for a number of reasons. It's there partly because global money flows are still finding our yields very attractive, even though the valuations are terrible. The yields are still attractive to an overseas money manager. And so global money flows are just causing all this distortion in our market. I've had several emails from people who watch these videos over the last few weeks asking me questions, particularly they're more beginner traders, asking me questions about day trading and short-term trading. And I just can't state strongly enough, that is a very hard gig at the best of times in a nice, orderly market. 2015 is going to be more volatile than we've seen in 2014. It's going to be difficult to trade, difficult enough to trade on a medium-term basis, even for professional traders. If you're a beginner, just completely forget about day trading. You're just going to lose your money. So what's required? A very disciplined approach to trading, and only the best quality stocks on the market is still essential. So it's much easier in America. I've been saying that for some time, and that's why most of our focus for members has been in that area. But certainly, you need to be very, very careful in the Australian market. Turning now to commodities, gold was down by $50 on the week to $12.65. Sorry, that should be $11.65. The supply and demand fundamentals around gold still remain very supportive of higher prices. But the fact is, prices are not going higher. They have now turned down again, and gold broke critical support on Friday night. I really didn't like what I saw. I was getting a bit nervous over the last couple of weeks. You may recall the last couple of weeks' videos I've said that, that this was starting to look more like just a bear market rally rather than the start of a new bull market, and that's the way it's turned out. So more downside in gold is highly likely now. However, I've still got to make the point that the gold stock indices are still outperforming. They're not falling nearly as much as gold. And that's the real mystery and dilemma for me, because gold stocks almost always lead the price of gold. If gold is going to go into a more extended downtrend, then gold stocks will normally get sold off before that happens, and vice versa in the other direction. And that hasn't happened. So I'm finding the gold market almost impossible to read at the moment, and hence my recommendation to members just to basically step back from the gold market altogether. So let's take a look at gold. We'll just have a quick look at the Australian ASX 200. There it is. It's been a very, very strong month or so. You could see we had a pretty good uptrend. We got a lengthy sideways consolidation, and then we started to move higher in January as a lot of overseas money flowed back into the country, and that's largely happened because the Australian dollar had gone through a significant fall, and the overseas money managers are betting that we're probably not too far from the bottom in the Australian currency, and so that brought a lot of overseas money back into Australian stocks, chasing that yield. I expect we'll probably trade down somewhere between 50 and 100 points on Monday, and then we'll see where it goes from there. Turning to gold, this is gold on a bigger picture weekly chart. So you can see we had this false break of the lows, or what was looking like a false break of the lows, and then a rally back up, which you could only really read as quite a good chance of a new bull market. But that's failed to materialize. We've now fallen again, and that was quite a sharp fall under that key support at 1190. And if we look on the daily chart, you can see it was an extremely sharp fall in gold on Friday night. So as I said, I cannot read the market at the moment. It's too hard, so just leave it alone is my overwhelming advice. Now turning to other commodities, copper declined a bit to 262. That's largely to do with the US dollar, and the US dollar index has started charging off again, and hence the Australian dollar coming down. The price action in copper was starting to look tentatively bullish. We had a move back above the 50-day moving average. We pulled back on in the latter half of the week, but the price action in copper is not looking too bad. West Texas Intermediate crude remains steady at 49, but expect more downside yet, I believe. The fundamentals are just nowhere near good enough for oil to turn around yet. And there's the spot copper chart. I'll just show you the US dollar index just to give you an idea of where the Australian dollar is likely to be going. Okay, this is the dollar index. So you can see it's been a massive run from around 79, and we're now up pushing towards 98. Now the next resistance level, you've really got to, you could really make a case, particularly the way the euro's going, that the American dollar index could eventually find its way back to those highs at 120. Now, if that's the case, the Australian dollar has got quite a bit further to fall yet. So we've had a consolidation period, very little retracement, and now it's just charged off again. So I think the possibility of the Australian dollar at 70 cents or even sub 70 cents is quite real. So turning to I know this has been a bit long, so I'll wrap it up here, but I think this was a really pivotal night of events on Friday night, so worth spending a bit more time on. Volatility is going to keep spiking throughout 2015. There's no question about that. We've got so many triggers out there. So the question is, how do you play those sort of markets and win when clearly the risks are rising? And the answer is, you've really got to zero in on the best fundamental stocks, the good value stocks that go with those really good fundamentals, and then you've got to trade them actively. Now, I'm not talking about buying and selling every second day, but when you've made some good profit and the price has got ahead of itself, and if you don't know how to find good fundamental stocks, if you don't know how to value stocks, and if you don't know how to read price charts, then you need some assistance, and I can help you with that for non-members. Members know very clearly all the support services that I provide in that regard. So you need to be very active, I believe, in the market. The other reality is that most Australian stocks are overvalued. There's no question about that. That doesn't mean the prices are going to come down, but you've just got to recognise that in America there are risks, but the risks are far lower in America than they are in Australia. Now, I said this last week, we got held up a little bit with some compliance requirements, but there will be some details out this week for non-members on a global fund that I'm running. For those of you that perhaps the thought of going overseas is just not really what you want to do, and you would be appreciative of another alternative, then those details will come out during this week. So for anyone else, if you wish to consult with me, then there's my email address. Always happy to assist where I can. That's it for this week. Cheers.